This is the third in a short video that's setting up the values that we need to calculate the financial measures of profitability. We haven't actually got to those financial measures or financial ratios as of yet. We're still developing the information that we need. In the first video, we illustrated how you should take net farm income from operations and at least allocate a portion of that to unpaid family labor and management. We call that the opportunity cost of unpaid family labor and management. In the second video, we showed you how to add interest back so that you come up with something called adjusted net farm income, which treats the farm as if it has zero debt. In other words, all of the assets are owned. Now, in order to get rates of return, you have to divide profit by how much you got invested. But when Farm Financial Standards began their deliberations almost 30 years ago, one of the first questions that arose was, well, if you're looking at the amount of money invested in a farm, it's going to be different during the year. In other words, your average asset value in December 31st of one year is going to be different than it is December 31st of the next year. So if you're trying to get a rate of return on assets, which means you're going to take profit or some measure of profit and divide it by asset value to get a rate of return, then the question is, what do you use the beginning of the year or the ending of the year? Farm Financial Standards come up with a solution to simply add the two asset values together and divide by 2 to get something called average total assets. So what we need to do now is we'll go back to the J&J Farms and go to the balance sheet. Okay? When we get to the balance sheet, what we're going to do is I'm going to come down here and I'm going to add 3 rows. I'm going to say average, I guess I could spell, average total assets, average total liabilities, which will be debt, and then we're going to have average net worth. Now in each of these cases, what we'll do, like average total assets, just like I indicated, what we're going to do, we're going to go equal, and I'm going to go up here to farm assets, take the first year plus the previous year, which is really the beginning and the ending of the year, okay, and divide by 2. Okay, and that gives me total assets, sorry about that, I didn't put enough parentheses in. So this number is simply the beginning of the year assets and the ending of the year assets added up and divided by 2. All right, I'm going to do the same thing for liabilities. This will be equal to, and I'll open parentheses this time. I'll take total farm liabilities at the end of the year, add total farm liabilities at the beginning of the year, and divide by 2. That gives me average debt during the year. And again, I'll do the same thing for net worth. Equals, open parentheses, net worth at the end of the year plus net worth at the beginning of the year, and divide that by 2. Okay, so now what I've got in these new 3 rows, I simply have calculated the average asset investment on this farm, the average equity investment, which is net worth, and the average debt during the year, realizing that it would change all during the year. I simply took the beginning and ending values and averaged them by adding them up and dividing by 2. Now I will need these 3 numbers as I compute the different measures of profitability. I'll have to refer to these 3. Okay, these last 3 videos are simply setting the stage so that we can now go calculate the return on assets, the return on equity, and the cost of debt. And you'll see how powerful it is to understand those 3 measures as we get them calculated and interpreted.